Hello everybody, Eddie here from Type Autan. Today I'm going to discuss the second assessment of BSBMKG501 as a tool to help you in addressing the task for this assessment. Okay, so the purpose of this presentation is to discuss the task requirements of assessment 2 and also the tools, concepts that we need to understand to address the tasks. All right, now this one here is important. Please make sure that your assessment 1 has achieved a satisfactory result, as assessment 2 is the continuation of assessment 1. All right, a bit of a summary here of assessment 1. We should have suggested 2 new product or service IDs from assessment 1. And in terms of assessment 2, we will narrow down to 1 new product or service ID. So in brief, what we need to do is to narrow down out of these 2 new product service IDs, we are going to get 1. All right, now it is the continuation of assessment 1, and it requires us to evaluate the 2 new product IDs further. So we can recommend 1 of them using the 4 criteria: financial viability, that includes profit and loss statements, break-even point, and ROI or return on investment. Okay. And we'll also need to assess the risk of each product ID, each product or service ID. And assessment 2 also requires us to put all analysis together into the evaluation matrix. So we need to perform the evaluation matrix as well as a tool to evaluate this ID further. So we need to incorporate all of the analysis into the evaluation matrix. And lastly, in this assessment, we also need to communicate our analysis and make a recommendation to the management. Okay, before task 1, I would suggest that you outline the 2 new product service IDs that you recommended in assessment 1 that will be evaluated in assessment 2. So I would appreciate that if we do not write the product IDs as still opportunity 1 and opportunity 2, but you relabel it, okay, and briefly describe your new product or service IDs. Okay, now we need to evaluate each of these opportunities or these new product service IDs in terms of these 4 criteria: the likely fit with the organizational goals and capabilities, the impact on current business activities, and also the impact on the current customer base, and lastly, potential competitors. Okay, now the organizational goals, right, which is basically the first criterion, would suggest that you do the SMART principle. You outline all factors briefly. For instance, the first criterion is about the organizational goals. Please suggest the possible organizational goals using the SMART principle. Okay? And in terms of organizational capabilities, you can also refer to your SWOT analysis in regards to the organizational capability. So that could be brand name or management flexibility and so on and so forth. So your SWOT analysis should revolve around the asset, capability, resources of the organization. That's basically the strengths, weaknesses analysis. Right? In terms of the SMART principle, the organizational goals, that's what we mean by SMART principle. The first one is specific, which is basically about what we want to achieve. Okay, what we want to achieve. Is that sales that we want to achieve, sales increase that we want to achieve, brand awareness increase that we want to achieve, or customer loyalty increase that we want to achieve, or customer satisfaction that we want to deliver. Okay. Measurable which is basically what how much or how many that we need to deliver. So we could claim that we have achieved the objective. The next one is attainable. Can we achieve this? It is a matter of whether it makes sense or not for us to be able to achieve it. And relevant, which is basically about the owner of the objective have the skills and knowledge to achieve the goals. Is it relevant to the role? So if my role is marketing, does it mean I have to develop a computer program? So probably it's not relevant to my role. And the last one is time or time bound. When do we have to complete the goal, or this is about the timeline? Okay, so well, you can guess which one that meets the SMART principle from this set of objectives. To increase sales in here. Is that specific? Yes, it is specific. This sales that we want to achieve. Is that measurable? No, it doesn't show how many or how much sales increase that we need to achieve. It doesn't show the timeline either. Okay, so we need to fix that. Okay, this one here is not doesn't meet the SMART principle. Okay. If you look at C, for instance, to reduce cost by 10% by the end of 2016, reduce costs. Is that specific? Yes, it is specific. These objectives is actually about reducing costs. Reducing costs in here is the objective. So this objective does not talk about any other objectives such as the sales or customer loyalty and so on and so forth. It's specifically about cost. Is that measurable? It is measurable, 10%. If we achieve 9%, then we are not good enough. If we achieve 10%, yes, we have met the goal. Okay? By end of 2016, is that time? Yes, it is time. This is the timeline that we need to deliver by that time. Is it relevant? Well, assuming that we work in marketing or finance, yes, it is related to us. In terms of marketing, of course, we want to reduce the cost in relation to marketing elements. Is that attainable? Well, to test whether the objective is attainable or not, it requires us to look at the previous objectives, and it also requires us to look at the resources that the company is ready to put forward to put in to reduce the cost. Okay? All right, so that's some. There are a couple of examples in terms of SMART principle. Right, now let's move on to the next one, which is basically the impact on current business activities. Here, I would suggest that you briefly describe the current business activities. You could imagine it is a cafe business. You can model any cafe that you're familiar with and specify what they do. You can also refer to the scenario in terms of what they do, what they're offering, what the products that they're offering, and so on and so forth. And next one is to outline the impact to the business if you launch the first new product or service ID, and if you launch the first or the second new product or service ID. Additional resource requirements. This one here is about outlining the additional resources. As a business, you must prepare the resources to launch a new product or service. Right? So here you need to detail that. Okay, does it mean you need some examples include whether you need some more staff, or whether you need to train your staff, or whether you need some more equipment. Okay, there are some examples that we can also refer to. And impact on current customer base. Impact on customer base, you could briefly describe the current customer base. You can refer to the scenario. You'll be able to find short this description about the customer profile. And you can also look at their final buyers as well. Now, in terms of impact, you need to outline what the impact would be if you launch the first new product or service ID, or the second new product or service ID and outline the possible impact. The possible impact could be switching consumption from the current product to new product. That's what we normally call as the cannibalization. So we may cannibalize the current products that customers normally buy to the new product or service that they would buy. Okay? And that, from financial perspective, that is one thing that we also need to anticipate. If we are going to lose profitability or we even increase the profitability. Okay? And prepare a space or train the staff for new products, for instance, that may be the other impact as well. Okay, now the next one is basically about the potential competitors. Here we're talking about the briefly the potential competitors, who they are, and can model the cafe that you're familiar with. You could describe who they are, how good they are in terms of competing with you, and you also need to ask yourself as a business whether you can compete with them or not. Okay, so in brief, you also need to outline what you need to do, whether you are good in managing the competition with when you launch the opportunity 1 and opportunity 2. Okay, so summing it all up, you can use this kind of template to address task 1, organizational capabilities, goals and capabilities. You outline your analysis here, and impact on current business activities, and so on and so forth. You outline your analysis in here, okay, referring to the previous concepts. Okay, now we are coming to task 2, which is basically about the financial viability. Why financial viability? Well, because it is critical for businesses to understand the reward. Launching a new product is considered as high risk. So businesses need to understand what sort of reward that they can expect. And one of the reward they expect is the financial reward. It could be profit and loss analysis, return on investment, and also break-even point analysis. Since there are 2 new product or service IDs, therefore, you need to deliver 2 profit and loss statements, 2 ROI calculations, and 2 break-even point calculations. All right, maybe confusing, but let's stay tuned. Okay. Right, now let's revisit their key financials in the short scenario. This is the revenue that we got from the short scenario case study. COGS, market and operational expenses, net profit, and we also know that coffee and pastries products contribute 80% of sales and profits. Okay. So we can refer to these percentage, for instance, when we build our own financial projection for the new product or service ID. So right, let's have a look at that. If we put all figures into the template, into the profit and loss template, we could get this kind of figure. This is the revenue. The COGS is 60%. That's what I said in the scenario. Therefore, COGS would be $480,000. By the way, everything should be calculated against the revenue. Therefore, as a result, since gross profit is calculated as the difference between revenue and COGS, we get 40%, or in other words, it is $320,000. And the case study also suggests that the marketing and operational costs contribute 27.5% of the revenue. Therefore, it is around $220,000. Net profit would be $100,000. Right, so how much of sales, how much percentage of sales is their net profit, right? Remember, guys, we need to calculate that against the revenue, right? So it is actually as simple as $100,000 divided by $800,000. So we are expecting 12.5%. Right, now let's construct our own profit and loss statement. There are 2 things that we need to estimate, first of all, okay? Sales and costs. And we also need to build the assumption lists. Please also consider realistic sales projection, given the first cafe's revenue is $800,000. And marketers use a number of techniques to estimate sales that include product acceptance research, market build-up technique, or any, including volumetric research, for instance. Okay. We'll discuss one of them in this presentation, which is related to market potential analysis in Assessment 1. Okay, so to make it kind of sensing whether it is realistic or not, if the business is $800,000, would the new product ID with $5,000 revenue be compared to first cafe? You judge that. All right, now let's look at the sales projection, which is the first thing that we need to do in constructing a profit and loss statement. The Assessment 1 suggests that we need to do the market potential analysis in dollar value. Okay? So if you have done that, you could estimate, or you could target a certain market share level that you want to achieve, like 2%, 3%, 5%, and so on and so forth. Right? Remember, you did that market potential analysis using the market build-up technique. Now, if we target 5% market share of, let's say, for argument's sake, with the market build-up technique, we understand the market potential in that area is around $5 billion. Okay, that suggests that our sales revenue target would be $50,000. Okay, so that goes into our profit and loss statement. Right, so we've got the sales revenue estimate already. Now, we need to estimate costs and other expenses. Okay? There are a number of things that we can do. Okay, for costs, I would suggest that you refer to the first cafe's profit and loss statement shown on slide 20. Let's go back to slide 20. There you go. So that's costs, right? $480,000 out of $800,000. How do I get $480,000? Well, if you look at the case study, it is 60%. 60% off $800,000 would be $480,000. Okay, so they are 60%. The cost is 60%. Okay, now what does it mean for us? You could assume their cost would be at the same level, 60%. Right, so you can calculate your the cost of your new product or service based on these 60%, referring to the current profit and loss statement. Okay, why 60% is the assumption that we can use? Because in real life, businesses do not want to lose money when they launch new product or service. Okay, because you will recall that when we discussed about the impact to customers, impact to current customer base, we do not expect them to cannibalize the volume of the existing product. Well, that's what we expect. However, in real life, there may be some cannibalization. The current customers are buying the existing product that generates 60%. That generate 40% gross margin because the cost is 60%. If when we launch new product and they shift their consumption to new product, that means cannibalization. That's what we mean by cannibalization. If the cost is more expensive with the new product, that means we are going to lose profitability. Okay, that's the reason why businesses would normally target at maximum the same level of costs for their new products or services. Okay? And in other words, 60% is the benchmark for our new products or services. But in some instances, companies may also accept higher costs than the current costs across the board if they consider the new product or service ID is very strategic. Okay, for instance, they may hear that the competitors will launch this product or service ID. So to preempt that, they may come up to may come to the market, launch this new product to preempt this action, okay? And they may take a lower profitability, and normally they would also work towards the cost reduction, so they would come back to the same level of costs. Okay. Right. So we've got sales and COGS. Okay. If that's the case, then we should be able to calculate gross profit, which is basically the difference between sales and COGS. Okay. Remember, in brief, profit is calculated as the difference between sales and expenses. Now let's look at the other costs. The profit and loss statement suggests 27.5% marketing operational expenses. You can break them down this percentage for marketing and operational expenses for your profit and loss of new product. For instance, marketing would be 15% and operational expenses would be 12.5%. That is one approach to address these assessment task. You can also calculate, you can also construct your own marketing and operational costs based on your own research. Right? Right. So they will become our basis to calculate these expenses. Okay? With that, we should be able to construct the complete profit and loss statement. And that will help us to generate the net profit before tax, or PBT, profit before tax. Okay. Right, so now net profit, it is actually gross profits less all expenses. That's how we get the net profit. And expenses can be variable, fixed, or discretionary expenses. Now let's have a look at that further. Variable expenses change in proportion to volume, right? For instance, wages, freight, okay, freight costs, they are variable. Fixed costs do not change in relation to volume, like rent, machinery, the admin costs, or the management salaries, for instance. Okay, so they are considered as the fixed expenses. And discretionary expenses refer to the business-related expenses, which can be deferred, like advertising or entertaining. Okay, now let's have a look at the expenses further. Okay. There are things that will be or have been paid and relate to the business. They are what the business uses their money for in the day-to-day running of the business, the cost of running a business. Okay, now let's discuss about the RI. Okay, it is always the intention of the companies to drive growth, and in doing so, they need to invest. Like anybody else, when we invest, we need to find out if our investment is viable or not. Okay? And a lot of techniques have been developed for investment appraisals. Okay? This includes the accounting techniques and discounted cash flow techniques. Now, in this assessment, and also in this presentation, we are going to look at the RI, which is basically part of the accounting technique, not discounted cash flow. Right? It is actually defined as the ratio between net return and investment costs that generate the return. In other words, from mathematical perspective, RI is net return divided by investment costs. Okay? Now, some companies also prefer to look at the return on market investment. They only want to look at the market investment, therefore they are analyzing ROMI, return on market investment. Okay, now if you look at this example, let's say a business invests $1 million to generate $1.2 million return. Okay? We need to determine the RI for this investment. If you look at that, the first step that we need to do is to calculate the net return. Okay, the total return is 1.2, so we need to look at the net return. 1.2 million minus $1 million, so we get $200,000 net return. Since the investment itself is $1 million, so we'll get the RI as $200,000 divided by $1 million. We get 0.2. or we can convert that to percentage to be 20% ROI. For your ROI calculation, you could refer to the P&L statement to reveal the net return, and which is basically the difference between gross profit and investment cost, and divided by investment cost. Now, in terms of investment cost, you can refer to all expenses that you consider you need to spend for this new product launch. And you could also refer to marketing investment. If you do that, that means you are calculating growth. Okay? Both are fine. Okay? But you need to be consistent with your investment cost definition. Okay, the last thing in terms of financial viability is the break-even point sales analysis. This shows the volume where profit is zero. In other words, the revenue received that we received is equal to the costs as shown below. Okay? We know that in general, revenue minus costs equals profit or loss if the cost is larger than the revenue. Okay, simple. So if your revenue, if you're doing a small business, let's say you are selling a pencil at $10, and actually you bought that pencil at $6. You're actually making $10 minus $6, so you're making $4 profit. So same thing in here, right? Same principle. Okay. Now at break-even point, profit is zero. Okay. This is again actually the position when the revenue that we receive is enough to absorb all costs. Okay. Or in other words, revenue takeaway cost is equal to zero. Or, in other words, again, revenue equals to all costs that we spend. Okay, so that's what we mean by break-even point sales. Okay, now let's look at this equation to calculate the break-even point sales. BEP volume is calculated as total fixed costs divided by the difference between price and total variable costs per unit. Okay? So fixed costs include all costs that do not change regardless of the volume that we produce or sell. Okay? In other words, they are committed costs. And variable costs, on the other hand, are the costs that change due to changes of volume or volume produced or sold. Okay? Now let me just change the. Okay, let's have a look at these two costs further because they are quite important for us to understand. Okay, fixed cost is actually the cost that does not change due to volume produced or sold. For instance, equipment costs or machinery. Let's say we buy a machine that costs us $100,000. That cost is actually a committed cost. It doesn't change regardless of the volume that we sell or produce. Okay? If we sell 1 unit, we still have to pay $100,000. If we sell 25 units, then the cost the cost per unit will be $4,000 per unit. Okay? And if we increase our sales, let's say from 25 to 50 units, then the cost per unit will go down. So here you are looking at the total cost is the committed cost. We still have to pay for it. Okay? We can't go back to our supplier, the supplier of the machine. Hey, I can only sell 25 units. Can I just pay $4,000? Right? We can't do that because it is committed cost. This cost is another one. Okay, let's say if we have the packaging cost per unit, $2 per unit. Okay, this cost will go up because of the volume that we produce or we sell. If we sell 25 units, for instance, the total cost of that packaging cost would be $50. And if you look at that, it goes up. If we sell 25,000 units, then our cost would be $50,000. Okay, so hopefully that gives you an illustration in terms of fixed cost and variable cost. All right, now let's have a look at the equation again to calculate the break-even point sales, which is calculated as the total fixed cost divided by the difference between price and variable costs per unit. Right? So, in other words, the information that you need include price, volume, or number of units that you plan to sell, fixed costs, and also variable costs. Okay. Now, this is what. The first thing that you need to do is look at your profit and loss statement. Let's say if this is our profit and loss statement, okay, ignore the numbers, guys. I just want to give you an illustration here. Let's say this is our profit and loss statement for that new product or service. So you need to consider whether cost is part of fixed cost or variable cost, advertising, sales promotion, and so on and so forth, right? And put your definition, your assumption list. Right? Let's say if we have removed the depreciation in here into our other costs, okay? So we could also argue that all costs in here are variable costs because we have removed the salaries component, the depreciation component from the costs component. In real life, some companies may mix the fixed cost and variable cost in their costs, right? So we got the fixed cost in here. Now advertising, right? Well, with advertising, regardless of the volume, you can argue that regardless of the volume that you sell, you still have to pay your advertising agency. If this is the amount of money that you have committed and you have signed, you still have to pay for it, regardless of the volume that you sell or produce. Okay, same thing to the other marketing costs. Distribution freight costs, you could ask yourself whether freight costs will go up or down if you sell or if you deliver or ship more or less volume. Okay, so from there, from your profit and loss, you can make a decision which costs go to your fixed costs and variable costs. And the next thing that you need to do is you add them all. So you'll get total fixed costs and total variable costs. Okay. Then let's look at your variable costs. Okay. We need the variable cost per unit. Therefore, you need to go back to your volume projection. You divide the total variable costs by the number of units that you plan to sell in your profit and loss statement. Okay. There you go. You've got the total variable cost per unit as well. Now, at this point of time, you've got all numbers. You've got the fixed cost, you've got the price, you've got the volume, you've got the total variable cost per unit. Okay? So you can put them all numbers, into the equation. Okay? Now, please note that the assessment template is just a different equation, which is fine. That's the equation that you use, costs per unit. I personally prefer to use the variable cost per unit because probably not all variable costs have been included into the cost. But you can also use that equation your assessment. Okay, now let's move on to task 3, which is basically key risks. Right. So here we need to outline the risk assessment for these new product or service IDs. Use the template, suggest 3 key risks for these 2 new product IDs. Therefore, you need to create 2 risk register tables. Okay. My recommendation for you is to be specific in terms of risk. Again, guys, please understand that risk is defined as the effect of uncertainty on objectives. Okay, so they have not happened yet. You anticipate it may happen. Okay, and it may bring risk. It may threaten your objective achievements. Okay? It could be from your competitor. It could be from your internal. It could be from any other external environment as well. Okay. Now. We've come to the last task, which is basically rank and describe the 3 marketing opportunities. Sorry, my apologies, the 2 marketing opportunities. Or 2 new product or service IDs. Right? So we need to rank them. Okay. In doing so, please use this template. The reason why you need to use this template is because this template has incorporated the importance of each factor that we analyze, and also how each new product or service ID delivers the factor. How do they perform against each factor? Okay. So how do we fill this out? Well, first of all, you need to write the factor weight. You can write it from 1 to 5 or 1 to 10, okay, but be consistent, okay. Let's say you write a potential market as 2 or 3. Then the next thing that you need to do is to write this opportunity 1 against the potential market. How do you do that? Go back to your assessment 1. You compare which new product ID provides a larger market potential. That is the reason why you must calculate market potential. If you don't calculate it, you can't address that task. Okay. Let's say new product ID. The first new product ID, where we analyze the first new product ID, will generate $100,000 potential market. Okay, and the second one would generate $250,000. Therefore, the first new product ID would be rated less than the second new product ID. Okay, let's do a bit of numbers in here. Okay, we say this one here is 3, and the opportunity 1, since it is generating $100,000, it is just 6, just a bit larger than the average. And in terms of second new product opportunity, we say it will generate $250,000. So it will be 8. Okay, and we do the rest. We do the same thing with the fit with organizational goals. You refer to assessment 1. Impact on current business. You refer to assessment 1. Financial viability. You refer to the profit and loss. You refer to the RI. You refer to the break-even point analysis that you did. Okay? In terms of profit and loss, you would expect the larger profit. The product with the larger profit would be rated better. And in terms of RI, the larger RI would be rated better. And in terms of BEP, the product ID that generates lower BEP volume would be rated better, because the lower the volume of BEP, the easier for you to achieve. Okay, let's say from financial viability perspective, we rate it as 7, and the first new product ID generates 90,000 profitability, for instance, 90,000 profits, $90,000 of profits, and the RI is 15%, and the break-even point is 1,500 units. And therefore, we're happy with it, so we would rate it as 8. Now, this one here is lower in terms of profit, lower in terms of RI, but higher in terms of volume that we need to achieve. Therefore, it will be rated as less. Let's say it will be 5. Okay. So after you complete everything in here, next thing that you need to do is you do the weighted rating. Okay. How do we do that? We multiply factor weight and rating. Okay. 3 by 6, we should get 18. Okay. And 3 by 8, we should get 24 in here. And here we get 56, here we get 35. Okay? After we calculate everything, please add them all. Let's say here we get A. Just put it in a different color. Okay? And here we get B. Okay? There you go. Your task is actually to compare which one's larger, A or B. Okay? If B is larger, then B is the one that you would recommend to launch. If A is larger, A is the one that you would recommend to launch. Right? Now, following that, you need to communicate the analysis and recommendation. Right? If you recommend product A, any product or service A, then that's one that you would recommend to the management team in your email, okay, in your communication. Now, your communication should include these elements: the situational analysis, description of the product, the Okay, summary of 405 forces and SWOT analysis, organizational and operational changes, and also brief discussion of financial viability, and draft the email. Okay, so what we need to do is to refer to the previous tasks. Okay, highlight your past analysis in your situational analysis. Describe the new product or service idea that you would recommend. If it is A, you describe product A. This is the product I would like to launch. Right? And summary of 405 forces analysis and SWOT analysis, and summary of the organizational operational changes that you need, so that you can adopt so that you can launch this new product or service idea. And brief discussion of the financial viability of this product A. That includes the profit and loss, BEP, and also ROI. And draft the email, right? That includes those highlights. Okay. Okay. Again, we recommend you not to, not to get stuck, and because we would recommend you to attend the assessments and contact us. Okay, contact us. That's our phone number, and that's our email address if you need to get help. And our marketing, our team of business marketing and business services teachers are always available to help you. Okay, good luck.